Hi, I'm Adrian Saville of Cannon Asset Managers. In our last review, we spoke about the circumstances facing the South African economy and pointed to some silver linings. Amongst others, restrictions on visas had been lifted, and there was announcements pending around the release of spectrum, which would have important implications for the information communication technology sectors. Since then, however, we have gotten to the business of foot shooting, where SAA and Eskom grab headlines, and indeed the load shedding in the last part of the year is likely to have taken South Africa back into negative growth in the fourth quarter. In this update, I'd like to talk to you about three things: the world environment, the global economic environment that faces investors as we head into 2020, specific risks that emerge out of that environment, and then more specifically, the South African circumstance. In terms of the world setting, 2020 looks like it could deliver better economic growth than 2019. Indeed, updates around purchasing managers' indices, flash reports on consumer confidence and business confidence coming out of Asia in particular speak of solid to robust gains taking place in the likes of China, Korea, and Taiwan. To add to this, it seems as if Trump is softening his stance on the trade agenda, where an improvement in trade circumstances could add a very valuable tailwind to world economic growth. Both of those factors, the better mood in emerging market Asia and a release of trade restrictions or trade circumstances, would act as tailwinds in turn to South Africa, whereas a small, open and commodity-faced economy, South Africa would benefit from improved trade circumstances, better investor confidence, and arguably the more buoyant commodity prices that would correspond with this. All put together, it looks like the world economy could deliver in the order of a high 2% economic growth number for 2020. And for the sake of an exact forecast, we'd point to 2.7 as the number that all of this corresponds with. We'll change that number as we go through the year. And whilst it does look like the economic mood is better, there are specific risks facing the economy, the global economy. Amongst others, the doomsday clock has been nudged closer to midnight. This is the closest it has been since the 1950s. And 2020 is being nudged closer because of the nuclear agenda or the nuclear posturing and positioning being adopted by Trump. So his politics or his antics have shifted from trade to other agendas, which we would put a very clear risk over. A second and far more specific risk is the so-called coronavirus, which has emerged out of China in recent days. That has already led to a tragic number of deaths and thousands of illnesses that have put anxiety into policymakers and investors. In response, China has extended the Lunar New Year by 3 days into February in an effort to manage the risk and close down on the mobility or movement of people. A third risk that we would flag in the global environment is valuation risk. And rather than pointing to the so-called risky assets as a source of capital market loss, we would actually point to what are conventionally regarded as low-risk assets, in particular cash and bonds, or more specifically, cash and global bonds. Where in advanced countries, cash is yielding zero and in places negative returns, and bonds are priced comfortably in negative territory in some of the biggest markets. Germany leads the way in this. And so if you buy a German bond or if you sign up for a German money market, you can be guaranteed that in 10 years' time, if you hold your investment, you will finish up with less money than you have today. These are quite extraordinary risks that point to a particular position and agility and stance that must be adopted in the management of global assets. When it comes to South Africa, the term risk is overtraded. And there are three elements that I think deserve or demand discussion as we go into February 2020. The first is SONA, where our concern or anxiety is that it will be more around promise rather than delivery. The second is the upcoming budget reading, where particular attention has to be given to the very elevated current expenditure, which quite simply is unsustainable and demands action and a firm hand. We're not sure that the political conviction and courage is there. And it is indeed our third point, borrowed from Moody's, the ratings agency, that this flags, where we would put at 50-50 territory the chance that Moody's downgrades South Africa after the reading of the budget, for the simple reason that the necessary steps aren't taken in terms of fiscal consolidation and prudence. All of that said, the risk of a downgrade is already priced in to South African bonds, South African cash, and the South African rand. If you look at credit default swaps, I've said the South African rand, I'm wondering now aloud, who else has a rand? So I could have just said the rand. If you look at credit default swaps, a downgrade is already priced into South Africa. Having said that, and in good economic tradition, there is a however. And the however is this: if it's all priced in, if the risk is already in the market, and if investors aren't interested, we think that South Africa, for appropriate levels of exposure, offers really interesting opportunity. And indeed, we've just released a note where we've spoken about 3 South African businesses in the shape of Storage, the property real estate investment trust, Sabvest, the investment holding company, and Eltron, the well-known electronics business which is migrating into the cloud, offer investors good quality South African assets, exceptional management, world-class management at compelling prices with global exposure. My colleague Younger Nozabella, in watching me prepare for this presentation, says, well, this is interesting, I'm going to stick around and watch the end. Indeed, we think it is exactly that. It's interesting, and we would urge you to stick around and watch the end. Thank you for joining me.